Hello, my name is Alvin Brown. I'm a tax attorney, and today I'm going to talk to you about some offer and compromise special issues. Mostly these issues come up in offers and compromise based on data to collectability. The most prominent of these special issues is what they call a dissipated asset. If you have a tax debt and then you have access to money, let's say you're pulling money out of a 401k or closing out an IRA account, selling a car or selling a house, the IRS is saying, well, if you have a tax debt and you get this proceeds, you should, you have an obligation to give it to the IRS. If you don't give it to the IRS, they're likely to say, well, that's a dissipated asset. And that's the key term, dissipated asset. Well, the premise of that rule, and it's found in the Internal Revenue Manual, is that you took it out, squandered it, and therefore, that's the term dissipated. Squander equals dissipated. And the premise is that since you have the cash, you should give it to them. But you still can use proceeds for your reasonable and necessary living expenses. You need a roof on the house, so you pull money out of an IRA account to fix the roof. Well, that's not squandering money. That's certainly not dissipated. And so, in the Internal Revenue Manual, there are rules to say that defines what is dissipated, what is not dissipated. Certainly, if you need the money because you're unemployed, that's never going to be dissipated. Now, you just need the money for that purpose. If you sell one house and roll over to another house and you get some cash resulting from it, they say, well, you should have given that cash to the IRS. But maybe you needed that money for closing costs or some other thing. But anyway, I think the general rule is that if you have a good purpose for it, for this money, then that argument can be made. But be prepared to address the IRS claim that this is a dissipated asset. If it is a dissipated asset, they'll treat it as if the asset were that you never got rid of it. They'll deem you to still have that asset. So if you have access to $10,000 from the sale of an automobile and you don't buy another automobile, they're going to say, well, even if you spend that $10,000, they're going to assume it's dissipated, and they're going to deem, and if you spend the money on, however, they're going to say, we're going to treat it as if you never spent the $10,000. We're going to treat it as an existing asset. So they deem it to be an asset. Unfortunately, they can do this. I call this an advocacy issue. It's how good your advocate is in saying it's not a dissipated asset. It's a discretionary issue. They have a right to do that because Congress gave them the authority under 7123, it's the offer and compromise statute, to write the administrative rules. Well, even if there isn't a regulation on this subject, their Internal Revenue Manual has legislative effect, and the Internal Revenue Manual identifies the concept of dissipated assets, so it is what it is. If you're planning to sell some property, get your hands on some cash, and you have a tax debt, then you need to think carefully about it. You don't want to use that money to take a trip on vacation. You don't want to use that money to pay for a child's college tuition. They're going to say that's dissipated because paying for tuition is elective. It's voluntary. And your first obligation, according to the IRS, is give them that money. So be very careful. They go back a number of years for that. I've seen them go back 3 or 4 or 5 years on dissipated asset issue. Obviously, they can't go back before you have the tax debt. And there are independent reasons for it. I mean, you may need that money for child care, for a divorce settlement, for other things like that. Another concept, an important concept, is retired debt. Retired debt is mainly comes up in the case of automobiles, because you're allowed to have the operating expenses and the payments of buying an automobile or leasing an automobile. You can pay up to $489 a month on either a lease payment or a payment on the car loan, in addition to some operating expenses. But assuming that the car loan expires in 12 months, they use a 48-month multiple on discretionary income, excess income. So let me talk about that for a second. If you have $100 of income in excess of what you need for your basic support, they multiply that by 48 and they say, well, we'll settle for $4,800 as part of the computation of how they'll determine what you owe for an offer of compromise. So if they use that 48-month horizon and your car loan is going to be paid up in 1 year, 12 months, then they're going to assume that you have that money available to give to the IRS for the next 36 months. So it's just an issue to be careful of. If you're going to go into an offer of compromise, then it's probably wise to get rid of the car, lease a car, or trade it in, get a new car, and refinance it and get up to a 4-year loan. Then you're not going to have that issue. But it's a trap. And people aren't aware of the issue. They're going to get caught up in it. And look, $489 a month for 3 years is a lot of money that you can avoid giving to the IRS on some strategy with regard to planning offers and compromise. Another issue that comes up is valuation issues on real estate. Generally, they don't ask for appraisals on real estate, and they have some channels where they can get some approximations of real estate. They have a service that can get them some comparable sales and some opinions on real estate. They're always going to check the assessed value in the county that real estate is located in. You should always report the fair market value of your house, but remember that in this economy that we're in right now, our real estate prices have gone way down. So you should try and think of current values in this economy, because I think today, in 2009, the values are a lot less than they were a year ago or 2 years ago. So be very careful about the valuations, and as you probably know, the IRS will discount real estate by 20%. But, it's a judgment call. All real estate's unique. I mean, who's to say what any piece of property is worth? Well, some pieces are easier than others. If you're in a unit, where there's a condominium and there's 100 apartments exactly like yours, when there's a fairly, established market. A lot of people are in single-family dwellings. They're constructed differently, and they have different square footage, they're in different lots, so it's really hard to compare these things, but you should make a good faith effort to come up with a reasonable value. A lot of people think about, well, what price do I want if I sell it? Well, that's not where we are. We want to be conservative. There's some other issues I'm going to cut off for now. I just wanted to identify the fact that there's a lot of complicated issues in the Offer and Compromise program. Call me if you need any help in planning an Offer and Compromise. We're very good at it. We do it nationally. We do it with clients abroad where we do it. My phone number is 888-712-7690. My extension is 106. If you want to make an appointment to see me, you can talk to and make it with my legal assistant on extension 111. Anyhow, good luck to you. I hope you are successful in your planning and your strategies. The Offer and Compromise rules are a bit complicated, and I think if you have any questions, call me and I'll give you a free consultation. Thanks very much.